What if everything you thought you knew about paying taxes was completely wrong? Picture this. You work hard all week, earn your money through honest labor, and then discover that someone has taken a portion of your earnings without asking. Your first instinct? Anger. Your second thought? This isn't fair. But what if that seemingly unfair system was actually the most brilliant invention in human history? And what if understanding its true purpose could change not just how you see taxes, but how you see civilization itself? Today, you're about to discover the hidden story behind every dollar taken from your paycheck, every receipt that shows tax included, and every form you fill out each spring. This isn't another boring explanation of tax codes and deductions. This is the untold epic of how humanity solved its greatest challenge, balancing individual success with collective survival. You'll meet Kieran, a young merchant whose journey from confused taxpayer to enlightened citizen mirrors the transformation that awaits anyone brave enough to peer behind the curtain of our most misunderstood institution. Along the way, you'll uncover secrets that will make you see every public road, every school, every police officer, and every hospital in a completely different light. Warning. Once you understand the true nature of what we call taxation, you can never go back to seeing it as simple theft. You'll discover that the system you've been taught to resent is actually humanity's most sophisticated achievement, a delicate balance of individual freedom and collective responsibility that took centuries to perfect. Are you ready to have everything you believed about taxes turned completely upside down? Because in the next few minutes, your journey begins in a mystical marketplace where golden coins tell the real story of civilization itself. The question isn't whether you can afford to listen to this story. The question is, can you afford not to understand the system that shapes every aspect of your modern life? Now, let us step through the ancient gates of the eternal marketplace, where cobblestones worn smooth by countless merchant feet will reveal the first secret of civilization's greatest mystery. In the mystical realm where commerce flows like rivers through ancient stone corridors, there existed a magnificent trading hub known as the Eternal Marketplace. This was not merely a place of buying and selling, but a living ecosystem where the fundamental principles of civilization revealed themselves through the daily dance of exchange and contribution. The story begins with a young spice merchant named Kieran, whose weathered hands had just completed his first successful week trading rare saffron threads in the marketplace's eastern district. The satisfaction of honest labor filled his chest as he counted his earnings. 100 golden coins, each bearing the intricate seal of the Grand Council that governed all commerce within the marketplace walls. Yet as the week's end ceremonial bell tolled across the stone plazas, Kieran discovered something that would forever change his understanding of how civilizations sustain themselves. When he approached the counting house to collect his full earnings, the keeper of records informed him that only 80 golden coins awaited him. 20 coins had already been collected by the council's revenue scribes. This was Kieran's introduction to the Great Contribution, though he did not yet understand its deeper purpose. Like every merchant, craftsperson, and trader who worked within the marketplace's protective walls, he was required to contribute a portion of his earnings to sustain the very system that made his prosperity possible. The Great Contribution was not mere taxation as crude societies might understand it, but rather a sophisticated system of shared responsibility that had evolved over centuries of marketplace wisdom. Every individual who benefited from the marketplace's infrastructure, protection, and opportunities participated in maintaining and expanding those very benefits for all. As Kieran walked through the marketplace that evening, his coins lighter, but his understanding about to deepen, he began to notice details that had previously escaped his attention. The smooth stone pathways that allowed merchants to transport their goods safely between districts. The watchtowers, where trained guards protected traders from bandits and thieves. The elaborate system of covered walkways that sheltered commerce during harsh weather. The Grand Council's scribes had not simply taken his coins arbitrarily. They had collected his contribution to fund the very infrastructure that made his successful trading week possible. Without the marketplace's organized systems, Kieran would have been a lone wanderer in dangerous territories, his precious saffron threads vulnerable to weather, thieves, and the countless uncertainties that plagued independent traders. But the great contribution extended far beyond mere protection and infrastructure. As Kieran would soon discover, his 20 coins joined with contributions from thousands of other merchants to fund an intricate web of services that formed civilization's foundation. But Kieran's bewilderment was just beginning. The 20 missing coins held secrets far deeper than simple collection. Secrets that would soon be unveiled in the most unexpected way. The following morning brought Kieran an invitation that few first-year merchants ever received. A council scribe, distinguished by his deep blue robes embroidered with golden threads, approached Kieran's spice stall with a message sealed in silver wax. The Grand Council requested his presence at the Hall of Transparency, where the mysteries of the Great Contribution would be revealed. As Kieran walked through the marketplace's central district toward the imposing hall, he passed countless examples of how contributions transformed individual prosperity into collective advancement. The House of Healing, where skilled physicians tended to injured merchants and their families without requiring immediate payment. The Academy of Trading Arts, where young apprentices learned mathematics, languages, and negotiation skills essential for successful commerce. The Hall of Archives stood majestically beside the main thoroughfare, its marble columns supporting a structure that housed thousands of scrolls containing the marketplace's complete trading history, legal precedents, and contractual records. These resources were available to any merchant seeking to research market trends, verify trading partner credentials, or resolve disputes through documented precedents. Inside the Hall of Transparency, Kieran joined a group of merchants from various trades. A master blacksmith whose forge produced the finest tools in 3 kingdoms sat beside a textile merchant whose silk commanded premium prices across distant lands. A spice trader specializing in exotic peppers shared a bench with a jeweler whose craftwork adorned noble courts throughout the known world. The council's chief revenue philosopher, an elderly woman whose silver hair was arranged in elaborate braids adorned with gems from every corner of the marketplace, began to unveil the true complexity of the Great Contribution system. Her voice carried the weight of decades spent understanding how individual sacrifice created collective prosperity. The Great Contribution manifested in numerous forms, each designed to capture value at different points in the economic cycle. The earning contribution took a percentage directly from merchants' profits, ensuring that those who benefited most from the marketplace's opportunities contributed proportionally to its maintenance and growth. The exchange contribution added a small fee to every transaction, recognizing that each trade benefited from the marketplace's systems of measurement, currency standardization, and dispute resolution. When Kieran purchased rare peppercorns from a distant trader, both parties paid a modest contribution that funded the very systems ensuring their exchange was fair, secure, and legally binding. The property contribution required merchants who owned permanent stalls, warehouses, or workshops within the marketplace to contribute annually based on their property's value. These contributions funded the maintenance of the marketplace's infrastructure, from the intricate drainage systems that prevented flooding during rainy seasons to the elaborate network of underground storage chambers that kept goods safe during conflicts. But the system's sophistication extended far beyond these basic forms. The investment contribution applied when merchants sold properties, businesses, or valuable collections for more than they originally paid. If a spice merchant sold his established trading route to another merchant for a significant profit, the council collected a contribution on that gain, recognizing that the marketplace's stable environment had enabled the route's increased value. The council's wisdom ran deeper than Kieran had imagined, but the true genius of their system lay not in what they collected, but in how they calculated what each merchant owed. As the chief revenue philosopher continued her explanation, Kieran began to understand that the Great Contribution operated on principles of proportional responsibility rather than equal burden. The marketplace had developed an ingenious system called the prosperity scales, which ensured that contributions increased along with a merchant's success and capacity to contribute. The prosperity scales divided all marketplace participants into different contribution levels based on their annual earnings. A beginning apprentice, who earned fewer than 1,000 golden coins per year, might contribute nothing at all, allowing them to establish themselves without the burden of contributions during their most vulnerable period. A journeyman merchant earning between 1,000 and 5,000 coins annually contributed 10% of their earnings above the first 1,000. This meant that a merchant earning 3,000 coins would contribute 200 coins, leaving them with substantial resources to reinvest in their growing enterprises. Master merchants, whose annual earnings ranged from 5,000 to 20,000 coins, contributed 15% on earnings within this range, in addition to their previous contributions on lower levels. The system ensured that successful merchants contributed more as their prosperity increased, but never so much as to discourage enterprise and growth. The most prosperous merchants, those earning more than 20,000 coins annually, contributed 25% on their highest earnings. These master traders had typically built extensive networks, owned multiple trading routes, and employed numerous apprentices and journeymen. Their higher contributions reflected both their greater capacity to contribute and their increased utilization of the marketplace's most sophisticated services. Yet many merchants, particularly those new to the system, made a critical error in understanding how the prosperity scales functioned. They assumed that reaching a higher prosperity level meant their entire earnings would be taxed at that level's rate. This misunderstanding sometimes discouraged merchants from expanding their enterprises, fearing that increased earnings would result in disproportionately higher contributions. The chief revenue philosopher used Kieran's projected second-year earnings to illustrate the system's true operation. If Kieran's expanding spice trade brought him 15,000 coins in his second year, many would assume he would contribute 25% of his entire earnings. This misconception would suggest a contribution of 3,750 coins. However, the prosperity scales operated through graduated levels. Kieran would contribute nothing on his first 1,000 coins, allowing him to maintain basic living expenses. His next 4,000 coins would be subject to 10% contribution, resulting in 400 coins. His following 10,000 coins would incur 15% contribution, adding 1,500 coins. His total contribution would be 1,900 coins, not 3,750. This graduated system encouraged continued growth and enterprise while ensuring that the marketplace's most successful participants contributed proportionally to the infrastructure and services that enabled their success. The scales balanced individual motivation with collective responsibility, creating a sustainable system that grew stronger as the marketplace prospered. Understanding the scales was only the beginning. Now Kieran would discover the intricate dance of collection itself, a process both more complex and more elegant than he could have dreamed. The method by which the Grand Council gathered contributions varied significantly depending on a merchant's role within the marketplace ecosystem. Understanding these different collection methods revealed the system's flexibility and its ability to accommodate the diverse ways that commerce functioned within the eternal marketplace. For merchants employed by established trading houses, the process was elegantly simple. The trading house's accounting scribes automatically calculated and remitted each employee's contribution directly to the council's treasury. These merchants received detailed scrolls each month showing their earnings, contributions paid, and remaining balance. This system protected employees from the complexity of contribution calculations while ensuring steady revenue for the council's operations. Independent merchants like Kieran faced a more complex but ultimately more empowering process. They were required to maintain detailed records of their earnings throughout the year and submit comprehensive reports during the annual reckoning ceremony held each spring. This process demanded greater personal responsibility, but also provided independent merchants with complete control over their contribution strategies and business decisions. Freelance traders, those who worked for different trading houses on temporary assignments, occupied a middle ground between these two approaches. They received contribution statements from each employer, but were responsible for ensuring their total contributions matched their annual earnings. This system accommodated the flexibility that freelance traders valued while maintaining the council's revenue requirements. The annual reckoning ceremony itself had evolved into one of the marketplace's most significant events. Merchants gathered in the Great Plaza each spring to participate in a process that was part financial obligation, part civic celebration, and part educational opportunity. The ceremony began with merchants calculating their total earnings for the previous year, a process that required careful review of all trading records, contract payments, and investment returns. Next, merchants determined their total contributions already paid throughout the year. Employed merchants consulted the statements provided by their trading houses, while independent merchants reviewed their quarterly contribution payments. This step often revealed discrepancies between contributions paid and contributions owed, setting the stage for the ceremony's final calculations. The most crucial element of the annual reckoning involved the declaration of deductions. The Grand Council recognized that merchants incurred various expenses directly related to their ability to generate earnings, and these legitimate business costs could be subtracted from their earnings before calculating contributions. Acceptable deductions included the cost of specialized tools required for a merchant's trade. A jeweler could deduct the cost of precision instruments needed to cut and set gems. A spice merchant could deduct expenses for preservation materials that kept valuable spices from spoiling during long journeys. These deductions recognized that certain expenses were necessary investments in a merchant's earning capacity rather than personal luxuries. Professional development expenses also qualified as deductions. A textile merchant who traveled to distant lands to learn new weaving techniques could deduct those travel costs. An apprentice who paid for advanced training and negotiation skills could subtract those educational expenses from their taxable earnings. Travel and accommodation costs for business purposes were similarly deductible. When merchants journeyed to distant markets to establish new trading relationships, purchase rare goods, or explore emerging opportunities, these expenses were considered necessary business investments rather than personal travel. Charitable contributions to recognized institutions within the marketplace also qualified for deduction. The marketplace's social fabric was strengthened by merchants who supported the House of Healing, sponsored scholarships at the Academy of Trading Arts, or contributed to the care of retired merchants who had served the community throughout their careers. Yet even the most honest merchants sometimes faced the council's most feared process, one that could either vindicate the truthful or expose those who tried to deceive the very system that protected them. Following the annual reckoning ceremony, most merchants returned to their daily commerce with their contribution obligations satisfied, and their relationship with the Grand Council settled for another year. However, a small percentage would soon receive a message that could strike fear into even the most honest trader's heart. The Notice of Detailed Review. The Council's audit process represented both the system's integrity safeguard and its most intimidating aspect. Master Auditor Elena, whose reputation for thoroughness and fairness was legendary throughout the marketplace, explained that audits were not punitive measures, but rather quality control processes designed to maintain the system's accuracy and fairness for all participants. Audits were triggered by several specific circumstances that the Council's experienced analysts had identified as potential indicators of errors or intentional misrepresentation. Merchants who claimed unusually large deductions relative to their reported earnings would likely face review. A spice trader reporting modest earnings but claiming extensive international travel expenses would need to provide detailed documentation supporting those claims. Significant discrepancies between reported earnings and lifestyle indicators also raised flags for potential audit. If a merchant reported earnings of 5,000 coins annually but was observed purchasing luxury goods, maintaining expensive properties, or making investments that seemed inconsistent with their reported income, the council would investigate the source of their apparent wealth. Mathematical errors in contribution calculations, while often innocent mistakes, also triggered review processes. The council's scribes were trained to identify patterns that suggested either systematic errors in a merchant's record-keeping or potential attempts to manipulate calculations in their favor. The audit process itself was designed to be thorough but fair. Selected merchants received detailed requests for documentation supporting their reported earnings and claimed deductions. They were given reasonable time to gather these materials and could request assistance from council scribes if they needed help organizing their records. Master Auditor Elena had developed a reputation for discovering not only discrepancies that favored merchants, but also errors that resulted in overpayment of contributions. Her team's reviews had returned thousands of golden coins to merchants who had miscalculated their obligations, reinforcing the audit process's role as a fairness mechanism, rather than simply a revenue enforcement tool. Most audits concluded with minimal adjustments and educational feedback that helped merchants improve their record-keeping for future years. The council viewed these interactions as opportunities to strengthen the relationship between merchants and the contribution system, fostering better understanding and compliance through education rather than punishment. However, merchants who were found to have deliberately misrepresented their earnings or claimed fraudulent deductions faced serious consequences. The marketplace's prosperity depended on honest participation from all members, and those who attempted to benefit from the system while avoiding their fair share of contributions threatened the foundation of the entire community. The audit process was merely the beginning of consequences. What happened to those who refused to participate in civilization's grand bargain would shock Kieran to his core. The Grand Council had learned through centuries of marketplace governance that the consequences for contribution avoidance needed to be graduated, educational, and ultimately restorative rather than purely punitive. The system's response to non-payment reflected sophisticated understanding of human nature and the various reasons merchants might fail to meet their obligations. The initial response to missed contributions was always educational and supportive. Merchants who failed to make their required payments within the specified timeframe received personal visits from council liaisons trained to identify and address the underlying causes of non-compliance. Sometimes merchants genuinely misunderstood their obligations, particularly those new to the marketplace or those whose businesses had experienced significant changes. For merchants facing temporary financial difficulties due to market fluctuations, natural disasters affecting their trade routes, or family emergencies requiring significant resources, the council offered payment arrangement programs. These programs allowed merchants to fulfill their obligations over extended periods while maintaining their ability to continue trading and eventually restore their full contribution capacity. If educational interventions and payment arrangements failed to resolve the situation, the council implemented financial consequences designed to encourage compliance while covering the administrative costs of extended collection efforts. Interest charges were applied to overdue contributions, ensuring that delayed payments did not become advantageous compared to timely compliance. Merchants who continued to avoid their obligations faced increasingly serious interventions. The council possessed legal authority to claim assets directly from merchants' property, trading accounts, or business operations to satisfy unpaid contributions. This authority was exercised carefully, with preference given to claiming assets that would least disrupt the merchant's ability to restore their earning capacity and resume regular contributions. The most extreme consequence for persistent contribution avoidance was temporary exclusion from marketplace trading privileges. Merchants who refused to participate in the contribution system that supported their prosperity could lose access to the very infrastructure and services that made their success possible. This consequence was rarely imposed, but served as a powerful reminder of the mutual dependence that characterized marketplace society. The enforcement mechanisms varied significantly across different regions and marketplace systems. In the Northern Territories, the Revenue Office was overseen by the legendary Grand Marshal Silvius, whose silver-backed gorilla emblem symbolized both strength and wisdom in revenue collection. Merchants throughout the Northern Territories respected Silvius's reputation for fair but firm enforcement of contribution obligations. The Southern Archipelago's taxation authority operated under the guidance of Master Collector Orangia, whose organization's tropical bird symbol represented the far-reaching nature of their oversight. Orangia had developed innovative methods for tracking merchants who operated across multiple island markets, ensuring that contribution obligations were met regardless of the complexity of their trading patterns. The Eastern Kingdoms maintained their revenue collection under the authority of the Royal Revenue Council, led by Master Treasurer Capella. The Crown's traditional symbols adorned their official documents, reflecting the historical connection between royal authority and the obligation of subjects to support the kingdom's operations through their contributions. But not everyone in the marketplace bore the same obligations. Some were exempt from the Great Contribution entirely, and understanding why would reveal profound truths about justice and society. Not every individual within the marketplace ecosystem was subject to the Great Contribution, and understanding these exemptions revealed important principles about the system's social philosophy and practical considerations. The categories of exempted individuals reflected the Council's recognition that certain circumstances made contribution inappropriate or counterproductive. Apprentices and beginning merchants who had not yet established stable earning capacity were typically exempted from contributions during their initial learning periods. This exemption recognized that imposing financial obligations on individuals who were still developing their skills and building their customer base could prevent them from ever becoming successful contributors to the system. Merchants who had lost their earning capacity due to injury, illness, or other circumstances beyond their control received temporary or permanent exemptions based on their situations. The marketplace's social contract included recognition that individuals who had previously contributed to the system deserved support during periods when they could not maintain their earning capacity. Young individuals who had not yet reached the age of full commercial participation were naturally exempt from contribution obligations. However, they often benefited extensively from services funded by the Great Contribution System, including educational opportunities, healthcare services, and the security infrastructure that protected their families' commercial activities. Charitable organizations that operated within the marketplace to support merchants in need, provide educational services, or maintain cultural institutions were exempt from contribution obligations. These organizations were recognized as providing services that complemented and supported the Council's own efforts to maintain marketplace civilization. Religious institutions that served the spiritual needs of marketplace participants were similarly exempted from contributions. The Council recognized that these institutions provided valuable services to the merchant community, including moral guidance, community support, and cultural preservation that strengthened the social fabric supporting commercial activity. However, exemptions were not automatically permanent or universal. Organizations that began as charitable or religious institutions but developed significant commercial activities might find their exemption status reviewed and potentially modified. The Council's approach balanced respect for these institutions' primary purposes with recognition that substantial commercial activity should contribute to the infrastructure that supports it. The system also recognized that virtually every individual participated in some form of contribution at some point in their lives. Even those exempt from direct earning contributions typically paid exchange contributions when they purchased goods and services within the marketplace. This universal participation, even at modest levels, reinforced the principle that everyone who benefited from marketplace civilization contributed to its maintenance. As Kieran's wealth grew, he would learn what the most prosperous merchants had discovered. There were legal ways to optimize contributions that most people never imagined. As the marketplace evolved and some merchants accumulated substantial wealth, sophisticated strategies emerged for managing contribution obligations while remaining fully compliant with council regulations. These strategies revealed the complexity of advanced commerce and the need for equally sophisticated contribution systems to ensure fairness and sustainability. Wealthy merchants discovered that different types of earnings were subject to different contribution rates, creating opportunities for strategic financial planning. Investment income from owning shares in trading expeditions, for example, was often subject to more favorable contribution rates than direct trading profits. This differential recognized that investment income carried greater risk and required merchants to commit capital for extended periods without guaranteed returns. Master merchants who owned multiple properties within the marketplace could rent these properties to other merchants while claiming the maintenance and operational costs as business deductions. Even when the properties generated less immediate income than they cost to maintain, the merchants anticipated that property values would increase over time, eventually producing substantial profits when sold. This strategy, known as temporal profit shifting, allowed wealthy merchants to reduce their current contribution obligations while investing in assets that would appreciate and provide future wealth. The approach was entirely legal and often economically beneficial for the marketplace as a whole, as it encouraged investment in infrastructure and property improvements that benefited all merchants. Stock ownership in major trading companies provided another avenue for contribution optimization. When these companies distributed profits to their owners, the income was typically subject to more favorable contribution rates than wages or direct trading profits. This differential reflected the risk investors accepted by committing their capital to enterprises whose success was not guaranteed. Dividend income from successful investments was often taxed at approximately half the rate applied to active trading income. This favorable treatment encouraged merchants to invest in the long-term growth of trading enterprises, rather than focusing solely on immediate trading profits, promoting economic development and job creation throughout the marketplace. Wealthy merchants also benefited from various investment-related deductions that were less available to smaller-scale traders. Professional investment advice, sophisticated record-keeping systems, and advanced financial planning services were all deductible business expenses for merchants operating at sufficient scale to require these services. The most sophisticated wealth management strategy involved establishing business operations in regions with more favorable contribution environments. The marketplace system was composed of numerous affiliated trading centers, each with its own contribution rates and regulations. Merchants could legally structure their operations to take advantage of these differences while remaining fully compliant with all applicable regulations. Some trading centers had developed extremely favorable contribution environments to attract merchant investment and activity. The island republic of Kalem imposed no contribution obligations at all, seeking to attract wealthy merchants who would stimulate their economy through spending and employment rather than through direct contributions to government operations. The desert kingdom of Aurelia similarly eliminated contribution requirements, believing that the economic activity generated by wealthy merchant residents provided greater benefit to their society than direct revenue collection. The remote territory of Glacialis maintained minimal government services and correspondingly minimal contribution requirements, attracting merchants who preferred to arrange their own security and infrastructure services. These strategies weren't modern inventions. They were the result of centuries of evolution, conflict, and hard-learned wisdom about what worked and what destroyed civilizations. The great contribution system that governed the eternal marketplace had not emerged fully formed, but had evolved through centuries of experimentation, conflict, and gradual refinement. Understanding this historical development revealed both the wisdom embedded in current practices and the ongoing challenges that required continuous attention and adaptation. In the marketplace's earliest days, revenue collection was far more chaotic and arbitrary than the sophisticated system Kieran had encountered. Local strongmen claimed portions of merchants' earnings through simple force, providing minimal services in return and creating an atmosphere of uncertainty that discouraged long-term investment and economic development. The first organized contribution system emerged when merchants collectively established the Merchants' Protective Alliance, recognizing that coordinated action could provide better security and infrastructure than individual arrangements. This alliance collected voluntary contributions from participating merchants and used these resources to hire guards, maintain trading routes, and establish common standards for weights, measures, and currency. As the alliance evolved into the Grand Council, the contribution system became more formal and comprehensive. The Council's early philosophers recognized that successful commerce required not only security and infrastructure, but also education, legal systems, cultural institutions, and social support mechanisms that created stable, prosperous communities. The development of graduated contribution rates reflected hard-learned lessons about economic incentives and social stability. Early systems that imposed equal contribution requirements on all merchants, regardless of their earning capacity, had proven unsustainable because they prevented new merchants from establishing themselves while failing to capture adequate resources from the most successful traders. Conversely, systems that imposed extremely high contribution rates on successful merchants had discouraged enterprise and innovation, leading to economic stagnation and reduced prosperity for all marketplace participants. The graduated prosperity scales represented a carefully calibrated balance between these extremes, encouraging continued growth while ensuring adequate resources for collective needs. Historical records revealed fascinating episodes where contribution policy had intersected with broader cultural and economic developments. During the Great Spice Wars of the early marketplace period, debates raged over whether exotic imports should be classified as necessities or luxuries for contribution purposes. Merchants argued passionately that rare spices were essential ingredients for food preservation and medical treatments, not mere luxuries for the wealthy. Some historical periods had seen contributions imposed on goods that were later recognized as essential to commerce and civilization. The infamous banana controversies occurred when certain regions attempted to classify these nutritious and easily transported foods as luxury items subject to higher contributions, creating artificial barriers to affordable nutrition for working merchants and their families. Conversely, there were periods when valuable goods had been used not as sources of contribution revenue, but as instruments for avoiding proper contribution obligations. Corrupt officials had sometimes accepted gifts of rare spices, precious metals, or other valuable goods in exchange for reducing merchants' official contribution assessments, undermining the system's fairness and effectiveness. These historical episodes had shaped the modern system's emphasis on transparency, standardization, and clear legal frameworks. The Council's current practices reflected centuries of refinement designed to minimize opportunities for corruption, arbitrary enforcement, or unfair treatment while maintaining the flexibility needed to adapt to changing economic conditions. The marketplace's system didn't exist in isolation. Across distant lands, other societies had tried radically different approaches, with fascinating and sometimes catastrophic results. The eternal marketplace's contribution system existed within a complex web of relationships with other trading centers, kingdoms, and commercial hubs, each with its own approach to funding government operations and public services. Understanding these international variations provided valuable perspective on the relative merits and challenges of different contribution philosophies. The Northern Federation maintained some of the highest contribution rates in the known world, with their most prosperous merchants contributing up to 57% of their highest earnings to fund extensive public services. Citizens of the Northern Federation enjoyed comprehensive health care, advanced educational systems, sophisticated infrastructure, and generous support for arts and cultural development. Their high contribution rates reflected both the extensive services provided and a cultural philosophy emphasizing collective responsibility for individual prosperity. The island empire of Nippon had developed a contribution system that balanced high rates with extensive support for business development and technological innovation. With maximum contribution rates reaching 55% for the wealthiest merchants, the island empire reinvested heavily in research, education, and infrastructure that maintains their competitive advantage in high-value manufacturing and precision crafts. The southern continent's contribution approaches varied dramatically, but the Confederation of Austral Territories had established a system similar to the eternal marketplace, with maximum contribution rates around 45%. Their system emphasized practical infrastructure development, efficient government operations, and strong support for international trade relationships that benefited their merchants in global markets. At the opposite extreme, certain regions had virtually eliminated contribution requirements in attempts to attract wealthy merchants and stimulate economic activity. The tropical islands of Kylam maintained zero contribution requirements, funding their minimal government operations through fees charged to businesses and indirect revenue from increased economic activity. The desert trading posts of Aurelia similarly imposed no direct contribution obligations on merchants, instead generating revenue through licensing fees, transaction charges, and fees for government services. Their approach attracted merchants seeking to minimize contribution obligations, but also resulted in more limited public services and infrastructure development. The remote territory of Glacialis maintained minimal contribution requirements, partly because few merchants chose to operate in their harsh climate, and partly because their residents preferred to arrange their own security and infrastructure, rather than relying on government services. Their system worked adequately for the limited number of specialized merchants who operated in their territory, but would not be practical for a major commercial center like the Eternal Marketplace. These international variations in contribution policy created opportunities for strategic business planning, but also raised complex questions about fairness and sustainability. Merchants could potentially structure their operations to take advantage of favorable contribution environments. But this optimization had to be balanced against the practical needs of conducting business, maintaining customer relationships, and accessing essential services. Some regions had attempted to prevent contribution avoidance by establishing treaties and information-sharing agreements with other trading centers. These collaborative arrangements helped ensure that merchants paid appropriate contributions regardless of how they structured their international operations, while also preventing unfair competition between regions based solely on contribution policy differences. Armed with knowledge of these global variations, successful merchants like Kieran had learned to master the practical arts of contribution management, turning obligation into opportunity. For merchants like Kieran, who sought to manage their contribution obligations efficiently while maintaining full compliance with council regulations, mastering the practical arts of financial planning and record-keeping was essential. The most successful merchants developed systematic approaches that minimized both their contribution burden and their risk of errors or penalties. The foundation of effective contribution management was comprehensive record-keeping that tracked all earnings, expenses, and business activities throughout the year. Successful merchants maintained detailed logs of every transaction, contract payment, and business expense, recognizing that accurate records were essential for both optimizing legal deductions and demonstrating compliance during any potential audit review. Strategic timing of business activities could significantly impact contribution obligations without compromising commercial success. Merchants who anticipated high earnings in a particular year might accelerate necessary business expenses into that same year, reducing their net taxable earnings while making essential investments in tools, training, or property improvements. Conversely, merchants experiencing lower earning periods might defer certain business expenses until future years, when their higher earnings would make the deductions more valuable. This strategic timing required careful planning and deep understanding of both business cycles and contribution regulations, but could result in substantial savings over multiple years. The most sophisticated merchants employed professional advisors who specialized in contribution optimization and compliance. These specialists, known as contribution counselors, maintained expertise in the constantly evolving regulations, deduction categories, and strategic opportunities available to different types of merchants. Contribution counselors provided services ranging from basic annual preparation assistance to comprehensive year-round planning that integrated contribution considerations into all major business decisions. Their fees were typically deductible business expenses, making their services effectively subsidized by the contribution savings they generated for their clients. Professional assistance was particularly valuable for merchants whose businesses had grown complex enough to involve multiple revenue streams, international operations, investment portfolios, or partnership arrangements. The interaction between different types of earnings, various deduction categories, and international contribution obligations required expertise that few individual merchants could maintain while focusing on their primary commercial activities. Even with professional assistance, successful merchants maintained personal understanding of fundamental contribution principles to make informed decisions throughout the year. They recognized that effective contribution management was not about minimizing obligations at any cost, but about ensuring they paid exactly what was required while taking advantage of all legitimate opportunities to reduce that burden. The most important principle for practical contribution management was maintaining absolute honesty and transparency in all dealings with the council. Merchants who attempted to hide income, claim fraudulent deductions, or misrepresent their business activities not only faced serious penalties, but also undermined the trust-based system that made the entire marketplace civilization possible. But beneath all the practical strategies lay something far more profound: the philosophical foundations that determined whether a contribution system created prosperity or destroyed it. As Kieran's understanding of the great contribution system deepened through his second year of trading, he began to appreciate the philosophical principles that undergirded the entire structure of marketplace civilization. The contribution system was not merely a practical mechanism for funding government operations, but reflected profound ideas about individual responsibility, collective prosperity, and the nature of civilized society. The fundamental principle underlying the Great Contribution was the recognition that individual success within the marketplace was never truly individual. Every merchant's prosperity depended on infrastructure, security, legal systems, educational institutions, and cultural development that could only be maintained through collective effort and shared resources. When Kieran sold his rare saffron to a distant customer, that transaction was made possible by roads maintained through contributions, currency systems backed by council authority, legal frameworks that enforced contracts, and security systems that protected both merchants from theft and fraud. His individual skills and efforts were essential components of his success, but they could only flourish within the supportive environment created and maintained through collective contributions. This interdependence extended beyond immediate commercial infrastructure to encompass the entire social and cultural framework that made sophisticated commerce possible. The Academy of Trading Arts that trained skilled merchants, the House of Healing that maintained workforce health, the cultural institutions that preserved knowledge and traditions, and the research centers that developed new technologies all contributed to the environment that enabled individual merchant success. The graduated nature of the contribution system reflected sophisticated understanding of economic incentives and social justice. Lower contribution rates for beginning merchants encouraged enterprise and risk-taking during the most vulnerable phases of business development. Higher rates for successful merchants recognized both their greater capacity to contribute and their increased utilization of the systems that enabled their prosperity. This graduated approach also acknowledged that wealth creation within the marketplace generated benefits that extended far beyond individual merchants. Successful merchants employed apprentices and journeymen, created demand for services from other merchants, and contributed to the overall economic vitality that benefited all marketplace participants. Their higher contributions helped fund the systems that sustained this broader prosperity. The contribution system's emphasis on voluntary compliance, supported by education and assistance rather than pure enforcement, reflected deep philosophical commitments to treating merchants as partners in civilization rather than subjects to be controlled. The Council's approach presumed that most merchants would willingly contribute their fair share once they understood both their obligations and the benefits they received from the system. This philosophy was embodied in the transparency requirements that allowed merchants to see exactly how their contributions were used. Annual reports detailed spending on infrastructure, security, education, healthcare, cultural institutions, and other services, enabling merchants to evaluate whether their contributions were being used effectively to support the collective prosperity they all shared. The international dimensions of the contribution system reflected recognition that commerce and civilization increasingly transcended local boundaries. Merchants who benefited from trade relationships, security arrangements, and infrastructure that spanned multiple regions had obligations that similarly transcended narrow territorial limits. These timeless principles faced new challenges in an evolving world. The future of the Great Contribution would depend on how well it could adapt while preserving its essential wisdom. As the eternal marketplace continued to evolve and adapt to changing economic conditions, new technologies, and shifting political relationships, the Great Contribution system faced ongoing challenges that required continuous refinement and innovation. Understanding these emerging challenges provided insight into how contribution systems might develop in future generations. The increasing sophistication of international commerce created new complexities for contribution collection and enforcement. Merchants operating across multiple jurisdictions could structure their affairs to minimize contributions in ways that were technically legal but potentially undermine the sustainability of the systems that supported their success. Advanced communication and transportation technologies made it easier for merchants to shift their operations between regions with different contribution requirements. While this mobility created opportunities for economic optimization, it also raised questions about fairness and the long-term viability of contribution systems that depended on merchant loyalty and community investment. The Council was exploring innovative approaches to address these challenges while maintaining the fundamental principles that made the contribution system effective. Information sharing agreements with other trading centers helped track merchant activities across jurisdictions, ensuring that contributions were paid appropriately, regardless of how operations were structured internationally. New categories of deductions were being developed to reflect changing business practices and technological innovations. Merchants investing in experimental technologies, sustainable business practices, or social benefit projects might qualify for contribution reductions that encourage these activities while maintaining overall revenue adequacy. The philosophical foundations of the contribution system continued to evolve as marketplace society became more complex and interconnected. Debates emerged about the appropriate balance between individual incentives and collective responsibilities, the optimal level of services that should be funded through contributions, and the most effective methods for ensuring fairness across different types of merchants and trading activities. Educational initiatives were expanding to help merchants understand both their obligations and their opportunities within the contribution system. The Council recognized that voluntary compliance and community support for the system depended on widespread understanding of how contributions translated into collective benefits and individual opportunities. Research and development efforts focused on making contribution compliance easier and more efficient for merchants while maintaining accuracy and preventing fraud. New record-keeping technologies, Automated calculation systems and streamlined reporting processes were being tested to reduce the administrative burden on merchants while improving the council's ability to manage the system effectively. The long-term sustainability of the contribution system depended on maintaining public confidence that the system was fair, effective, and responsive to changing needs. This required ongoing attention to both practical operational issues and fundamental questions about the relationship between individual success and collective responsibility in an increasingly complex commercial environment. As Kieran's transformation neared completion, the ultimate truth about taxation would finally be revealed, a truth that would change not just his understanding, but his entire relationship with civilization itself. As Kieran completed his second full year as a merchant in the eternal marketplace, his transformation from confused newcomer to knowledgeable participant in the great contribution system reflected the broader journey that every civilized person must make in understanding their relationship to the collective foundations of prosperity. The great contribution was revealed not as a burden imposed by external authority, but as a sophisticated expression of the mutual dependence that made advanced civilization possible. Every merchant's success depended on infrastructure, security, education, legal systems, and cultural institutions that could only be maintained through shared resources and collective commitment. The system's graduated structure reflected deep understanding of economic incentives and social justice, encouraging individual enterprise while ensuring that those who benefited most from civilized society contributed proportionally to its maintenance and development. This balance sustained both individual motivation and collective prosperity across generations of marketplace evolution. The emphasis on education, transparency, and voluntary compliance demonstrated sophisticated recognition that sustainable contribution systems must be built on understanding and consent rather than mere enforcement. Merchants who understood how their contributions translated into personal and collective benefits were more likely to participate willingly and effectively in the system that supported their prosperity. The international dimensions of the contribution system acknowledged that modern commerce increasingly transcended local boundaries, requiring coordination and cooperation between different regions and trading centers. This cooperation balanced competitive pressures with recognition that all civilized societies faced similar challenges in funding the infrastructure and services that enabled advanced commerce. The historical development of the contribution system revealed that effective approaches emerged through experimentation, adaptation, and gradual refinement rather than through imposed theoretical perfection. Each generation of merchants and council leaders had contributed to the system's evolution, adapting to changing conditions while preserving fundamental principles that had proven their worth over centuries of testing. The practical arts of contribution management demonstrated that individual merchants could master the system's complexities while maintaining full compliance and optimizing their obligations. Success required understanding, planning, accurate record-keeping, and often professional assistance. But these investments in compliance typically generated substantial returns through reduced obligations and avoided penalties. The philosophical foundations of the contribution system reflected profound insights about individual responsibility, collective prosperity, and the nature of civilized society. The system embodied recognition that true individual success required supportive social institutions that could only be maintained through shared commitment and resources. As Kieran looked toward his future years as a merchant in the eternal marketplace, he understood that his relationship with the great contribution system would evolve from reluctant obligation to informed partnership in the grand enterprise of civilization. The wisdom he had gained revealed that the great contribution was far more than a simple extraction of wealth from successful merchants. It represented humanity's most sophisticated solution to the fundamental challenge of balancing individual ambition with collective prosperity. Every golden coin he contributed joined a vast river of resources that flowed through carefully designed channels to maintain the infrastructure of opportunity itself. Kieran's transformation from confused newcomer to knowledgeable participant mirrored the journey that every civilized person must undertake in understanding their place within the complex web of mutual dependence that enables advanced society. The marketplace's stone pathways, security systems, legal frameworks, and educational institutions existed because countless merchants like him had recognized that individual success required collective investment. The graduated nature of the prosperity scales now appeared to him as a masterpiece of social engineering. Beginning merchants paid nothing, allowing them to establish themselves without the crushing burden that would prevent their emergence as future contributors. Successful merchants paid progressively higher percentages, reflecting both their greater capacity and their increased utilization of the systems that enabled their prosperity. This understanding brought Kieran profound satisfaction rather than resentment. He was not merely paying taxes, but participating in the maintenance and expansion of civilization itself. His contributions helped train the next generation of merchants, maintained the security that protected his trade routes, and funded the innovations that would create new opportunities for future prosperity. The international dimensions of the contribution system now made perfect sense to him. Commerce increasingly transcended local boundaries, requiring coordination between different trading centers and kingdoms. Merchants who benefited from these expanded opportunities had corresponding responsibilities that similarly transcended narrow territorial limits. Kieran also appreciated the practical wisdom embedded in the system's enforcement philosophy. The emphasis on education and voluntary compliance, supported by transparent accounting and reasonable penalties, created a sustainable framework that could adapt to changing conditions while maintaining its fundamental integrity. As he prepared his records for his third annual reckoning ceremony, Kieran felt a deep sense of pride in his mastery of the contribution system's complexities. He had learned to optimize his legitimate deductions, time his business activities strategically, and maintain the detailed records that demonstrated his full compliance with all obligations. More importantly, he had internalized the philosophical foundations that made the system both effective and just. Individual success was never truly individual, but always depended on collective investments in infrastructure, security, education, and culture that could only be maintained through shared commitment and resources. The future would undoubtedly bring new challenges as commerce continued to evolve and expand. New technologies would create new opportunities and complexities. International trade would require ever more sophisticated coordination between different contribution systems. Economic conditions would test the system's ability to adapt while maintaining its fundamental fairness and effectiveness. But Kieran faced these future challenges with confidence, knowing that he was part of a system that had evolved through centuries of refinement and testing. The Great Contribution represented not just a mechanism for funding government operations, but a profound expression of the mutual dependence and shared responsibility that made civilized prosperity possible. In the end, Kieran understood that there were indeed only two certainties in life: the inevitability of change and the necessity of contributing to the collective foundations that enable individual flourishing. The Great Contribution system of the eternal marketplace had transformed him from a simple trader into a conscious participant in the grand enterprise of civilization itself. His journey from confused newcomer to informed partner in the marketplace community demonstrated that understanding, rather than mere compliance, was the key to finding satisfaction and success within any contribution system. When merchants understood how their individual sacrifices created collective prosperity, they discovered that contributing to civilization was not a burden to be minimized, but an opportunity to be embraced. The Chronicles of the Eternal Marketplace thus revealed the deepest truth about taxation in any society. It represents humanity's ongoing experiment in balancing individual freedom with collective responsibility, creating systems that enable both personal success and civilized prosperity to flourish together across generations. Years passed and wisdom deepened, but the true measure of understanding comes not in receiving knowledge, but in passing it forward to those who still see only confusion where clarity is possible. 10 years had passed since Kieran first entered the eternal marketplace as a confused young spice merchant, clutching his meager collection of saffron threads and wondering why 20 golden coins had vanished from his earnings. Now, as he stood before the grand entrance to the Academy of Trading Arts, his silver-threaded merchant robes marked him as one of the marketplace's most respected master traders. The Academy had invited him to deliver the annual address to new apprentices, those wide-eyed young merchants who would soon experience their own bewildering first encounter with the Great Contribution System. As Kieran looked out at their eager faces, he saw himself a decade ago. Ambitious, hard-working, but utterly mystified by the complex web of obligations and benefits that sustained their civilized prosperity. "You will each discover," he began, his voice carrying the weight of earned wisdom, "that the 20 coins taken from your first week's earnings are not stolen, but invested. They join the great river of resources that maintains the very pathways you walked to reach this academy, the security that protects your trades, and the knowledge that will transform you from mere peddlers into true merchants of civilization." Behind him, the marketplace bustled with its eternal rhythm of commerce. Stone pathways smooth beneath countless merchant feet, watchtowers standing vigilant against threats, the great halls of learning and healing humming with activity. Every element of this magnificent infrastructure existed because generations of merchants had understood what Kieran now taught. Individual prosperity flourished only within the garden of collective investment. In his private ledger that evening, Kieran recorded not just his trading profits and contribution payments, but a deeper accounting, the true measure of a merchant's wealth. His success was built upon roads he had not paved, laws he had not written, knowledge he had not discovered, and security he had not provided. The Great Contribution had revealed itself not as taxation, but as civilization's most profound expression of mutual dependence and shared responsibility. The young apprentices would learn, as he had learned, that there were indeed two certainties in life: the inevitability of change and the necessity of contributing to the foundations that enable all prosperity to flourish. In understanding this truth, they would transform from reluctant contributors into willing partners in the eternal enterprise of civilized commerce. As the marketplace bells tolled the evening hour, Kieran smiled, knowing that tomorrow would bring new merchants, new questions, and new opportunities to share the wisdom that the Great Contribution System was not humanity's burden, but its greatest achievement. And so the eternal cycle continues. In marketplaces around the world, new merchants discover what Kieran learned: that civilization's greatest achievement isn't the roads we build or the armies we raise, but the wisdom to transform individual success into collective prosperity. The Great Contribution isn't taxation. It's humanity's most sophisticated expression of our deepest truth: we prosper together or we fail alone.